Welcome, everybody. Welcome. We are so glad you're here. This is the 2013 Financial Planning Challenge How Do You Know competition. Congratulations, schools. You have done an awesome job to get here. For folks in the audience, I think you've been on the journey with the teams, but just to give a little bit of a refresher course, this was a journey that started back in June when the schools you see sitting before you and others submitted a written case to our panel of judges. The cases were reviewed and the finalists were selected. So before us are the 8 finalists for this year's case competition. I do want to take a moment just to introduce our esteemed panel of judges. We have first Marty Gillen, PhD. She's from the University of Florida and also works with the CFP Board of Standards. Next, we have Rita Chang. She is an Ameriprise advisor as well as heavily involved with the Financial Planning Association. And then finally is David Bressler, my colleague also from Ameriprise Financial. I have a couple of other folks that I do want to make sure that we mention. First is James Tissot. James has worked tirelessly to get us ready for this competition, this phase of the competition, as well as integral in the written and oral presentations, obviously, that you guys participated in yesterday. Folks from financial planning, so it takes a fair amount of coordination to get this many people to this point in the week. And I'd like to recognize Mary Corbin and Destry Downing. They have worked tirelessly. Last, Dr. Charles Chafin is an academic who was intimately involved with the writing of the case and has participated in the competition in years gone by. He's also representing the CFP Board of Standards. I'm Sarah McLeod. Oh, Charles, thanks. Finally, I'm Sarah McLeod. I will be your announcer for this year's competition. I am delighted to be here. As you know, this is the final phase of it, and I want everyone to take a deep breath, and we're going to have a little bit of fun today. I do want to run through a few rules just to make sure we're all on the same page. First of all, I will read each question, and I will read all of the answers. Students, you get 30 seconds. 30 minutes, wouldn't that be great? Students, you get 30 seconds to answer. There are assistants or proctors at your tables. You must submit your answers promptly to your proctors. There will be a practice question, so we're going to test out the process just to make sure we all know how it works. So don't worry, we'll get a trial run before we go to the real game. I do want to mention that there is the option for students to challenge an answer. So I think you all know how this works, but let's just make sure we're clear. If you want to challenge an answer, you may do so, but you must do it before the next question is read. And then we will turn it over to our esteemed panel of judges to adjudicate whether or not your challenge is acceptable. You have to provide your rationale. So if you are going to challenge, you have to provide why you think that answer is better. All right. We will take a break. So about at the halfway mark, roughly, we will take a break. Everyone can stretch their legs. This year, folks in the audience, I am delighted to announce that you will get to play along with the students. So on this side will be the audience participation screen. So I'm going to read how this works. You have 2 ways to vote for the answer that you think is right. You can either text the corresponding answer, and the numbers will be displayed on the screen. Or it's actually easier if you would like to go to a website. The questions are displayed on the website, and then you can just select your answer directly from the website. All of it through the miracle of technology are compiled, and ultimately your percentage correct answers will be displayed on the screen. The website, if you are curious, it's POLLEV.com/financial planning or FPA experience. POLLEV.com/financial planning experience. All right, a few reminders. Audience, we are so delighted you're here. Thank you so much for coming. Please remember, this is for the 8 finalist teams to participate. So as exciting as these questions are, please be careful not to be whispering among yourselves or so excited that you think you've got the right answer that you yell it out. We do need to make sure that everyone is given the same fair chance at answering the questions correctly. Please don't discuss the questions while the students are working. I just want to impress that on you. And again, it's going to be very, very hard this year because we're going to be seeing how you're doing as well. Finally, students, please relax. Everyone take a deep breath. We're going to get started with our practice question right now. Let's do it. Okay. Any final clarifications that we need to cover before I get started? Mary?
You might want to just say about that the practice question is going to be over here, but this is the official game board, and everything else will happen here.
Wonderful. Okay. Mary reminded me, the practice question, you're not going to see it on the student side. Everyone can look over here on the audience participation side. Okay, are we ready? Everyone ready for a practice question? Audience, are you ready for your practice question? Get out your iPhone, smartphone, and let's give it a shot. Zeke Wester is concerned about the stalled economy. Which of the following is the best way Congress can help stimulate the economy? 1, have every congressman and staffer take an oath to go to tanning salons until they are the same color as John Bonner. 2, increase government spending. 3, stay home and let the FPC students solve the problem. 4, it's a trick question. It's impossible for Congress to do anything. Mary, please start the clock. 30 seconds. Okay. Oh, sorry. You got it? Mm-hmm. Your timing.
No, this has a real timer.
10 seconds. 10 seconds. Time. Students, please submit your answers to your student helpers. All right, we're going to start with Kansas State University. How did you answer? Kansas State answered number 4. That is not right. The correct answer is number 2, increase government spending. Texas Tech, how did you answer? Number 2, Texas Tech answered correctly. Thank you. University of Incarnate Word. Number 4, also incorrect. University of Georgia, how did you answer? 4, not correct. Utah Valley. Number 2, congratulations, you got it right. VCU. 2, congratulations, you got it right. Virginia Tech. 4, I'm so sorry, you did not get that correct. William Patterson University. 2, you are correct. Congratulations, we got one done. Okay. Okay. So students, we're going to begin the competition now. I'm wondering, can we close the door? All right. Kansas State, you may select the first question. Principles for 100. So they have selected general principles for 100 points. I will read the question. Economic consultant Bud Jett conducted a seminar at his local library discussing fiscal policy and monetary policy. Which of the following is correct? 1, fiscal policy is the driving force of the prime rate. 2, the Federal Reserve Board may buy Treasury securities to stimulate the economy. 3, the discount rate applies to loans between commercial banks. 4, The discount rate is the most frequently used tool of the Federal Reserve Board. Mary, please start the clock. Ten seconds. Time. Please submit your answers. Okay, Kansas State, since you started us off, how did you answer? Number 2, that is correct. All right, Texas Tech. Number 2, that is correct. University of Incarnate Word. Number 2, you are correct. Georgia. 3, I'm so sorry, that's incorrect. Utah Valley. 3, incorrect. VCU. 2, that is correct. Virginia Tech. 2, that is correct. And William Patterson. 2, you are correct. How did our audience do? Oh my gosh, okay, wow. So the rationale here is the Federal Reserve Board may buy treasury securities to stimulate the economy. Buying treasuries puts money into the hands of the public. It is the most frequently used tool, even though the discount rate is the most visible. Fiscal policy is conducted by Congress and the President through the passage of laws. The discount rate applies to firms that borrow from the Fed. The prime rate is set by large commercial banks for their most credit-worthy customers. Okay. Texas Tech, it's your turn to select. Where should we go next? Principals 200. Finally, in a position to buy a home, Owen and Lotta Debt applied for a mortgage on a $325,000 home. They made a $20,000 down payment, financing the balance over 30 years. Pardon? 20?
20%.
Okay.
$20,000.
They made a down payment of 20% down, financing the balance over 30 years at 3.65%. What is their approximate monthly payment for principal and interest?
This is not fair, because we can't see the question on this side of the room. This text is too small over there. So it puts this side of the room at a distinct disadvantage.
Okay.
I can see it. That's a lot.
Okay, so Kansas State, you guys can see it now?
Yes.
Okay. Texas Tech, can you see the? You're good? Incarnate Word, yes? University of Georgia, can you see it? Okay. I'm going to reread the question, and we'll take it from the top. Okay. Finally in a position to buy a home, Owen and Lotta Debt applied for a mortgage on a $325,000 home. They made a 20% down payment, financing the balance over 30 years at 3.65%. What is their approximate monthly payment for principal and interest? Option number 1, $1,186. Option number 2, $1,190. Option number 3, $1,482. Option number 4, $1,487. Please start the clock. You have 10 seconds. And time's up. Please submit your answer, students. Okay. Texas Tech, how did you answer? Number 3. I'm sorry, that's not correct. The answer is number 2. University of Incarnate Word. Number 3, also incorrect. Georgia, answer number 2, you are correct. Utah Valley, answered number 3, that is incorrect. VCU, number 1, I'm sorry, that's incorrect. Virginia Tech, number 2, you are correct. William and Patterson, number 2, correct. The trick to this one is, oh, challenge. Okay.
No, K-State.
Oh, I'm sorry, Kansas State University, please answer. Number 2, you are correct. Thank you, we're warming up here. All right. The trick to this one is end mode. Does that make sense? And the 20% down payment. Okay. University of Incarnate Word, it's your choice. Where do we go next? Okay. Tax for 200. Philip Anthropy gifted stock to his nephew, Barry Generous. That's Sally's son. Stock that was worth $75,000. Phil bought the stock at $25,000 6 years ago and paid $30,000 in gift tax at the time of the gift. Barry then sells the stock for $65,000 8 months later. Barry's gain loss is option number 1, $20,000 long-term capital gain. Option number 2, no gain or loss. Option number 3, $20,000 short-term capital gain. Option number 4, $10,000 short-term capital loss. Please start the clock. Ten seconds. And time is up. Please submit your answers. Okay. University of Incarnate Word. What did you answer? Number 4. I'm sorry, that's incorrect. University of Georgia. Number 1 is correct. Thank you. University of Georgia? Or I'm sorry, Utah Valley. Option 1 is correct. Thank you. VCU? Option 3 is correct. Virginia Tech?
Option 1 was
Option 1 is correct.
they
I'm
had
sorry.
3.
You had 3. 3 is incorrect. Thank you. Virginia Tech, option 4, not correct. William Patterson, option 1 is correct. Kansas State, option 4 is incorrect. And Texas Tech, option 4 is incorrect. So the rationale here is that Barry will get the pro rata share of the gift taxes paid by his uncle added to the original basis. So its original basis of $25,000 plus the appreciation of $50,000 divided by the $75,000 times $30,000. That equals $25,000 plus $20,000 or $45,000. And the holding period of the donor carries over. Okay. University of Georgia, it's your turn to figure out where we go next.
We're going to stay with tax, please, go for 100.
Okay, income tax planning for $100. The Dodgett family owns a closely held business. Otto Dodgett sold 2031 property to his son, Will Dodgett, on an installment sale for $5,000 per year for 5 years with simple interest of 5% on the outstanding balance. Otto purchased the property 10 years ago for $100,000. It currently has a basis of $40,000. What is the tax treatment for Otto in regard to the loss in the year of the sale? Option number 1, you cannot sell 1231 property to a related party if there is a loss. Option 2, he will take a $2,000 capital loss. Option number 3, he will take the full amount of the loss after depreciation recapture. Option number 4, there will be no capital gain or loss. Please start the clock. Ten seconds. Time's up. Okay. University of Georgia. How did you answer? University of Georgia said number 4. I'm sorry, that is correct. Congratulations. Utah Valley. Option number 3. I'm sorry, that is incorrect. VCU. Number 4 is correct. Virginia Tech. Option number 2. I'm sorry, that's incorrect. William Patterson. Number 1 is incorrect. Kansas State. 3. I'm sorry, that's incorrect. Texas Tech. 3. I'm sorry, that's incorrect. And University of Incarnate Word, 3, that is incorrect. Okay, let's take a quick check at where we are. We have Kansas State with 300 points, Texas Tech with 100, University of Incarnate Word, 100, University of Georgia, 500, Utah Valley at 200, VCU at 200, Virginia Tech, 300, and William Patterson at 500. Congratulations, we've made it through 4 questions. Okay, Utah Valley, it's your turn. Where shall we go next? Retirement planning for 200. Did I get that right? Yeah. Okay, thank you. Wanda Leavitt is 40 years old and has worked for Glass Ceiling Inc., GCI, for the past 4 years. GCI has a 401k with employer elective contributions. GCI will match up to the first 3% of salary, utilizes the longest graded vesting schedule allowed, and normal entry dates to participants in the plan. Wanda makes $50,000 a year and contributes 5% of her salary to the plan. She has never received a raise and decides to leave after her 4th year. What is the vested dollar amount of combined employer-employee contributions? Option number 1, $9,600. Option number 2, $10,000. Option number 3, $10,200. And option number 4, $3,600. Please start the clock.
I don't know. The last option was at 3,600. It's 3,600.
Oh.
I didn't hear anything else. What's wrong?
10 seconds. And time is up. Please submit your answer, students. Okay. Utah Valley, how did you answer? Number 2. I'm sorry, that's incorrect. The answer is number 3. Virginia Commonwealth answered number 2. I'm sorry, that's incorrect. Virginia Tech, 4. I'm sorry, that's incorrect. William Patterson, also 4. Kansas State, 3. That is correct. Texas Tech, 4. I'm sorry, that's not right. University of Incarnate Word, 4. And Georgia, 3. That is correct. So the explanation, I'm sorry, was there a question from the teams? No, okay. So Audience also struggled a little bit with this one. We only had 2 people responding, if I'm reading that right, Benjamin. Okay, so Wanda is 100% vested in her contribution and 60% vested with her employer as part of that. What must be remembered is Sally did not enter the plan until the 2nd year of employment. Years of service not eligible for participation that count towards vesting. Therefore, Wanda can contribute $25,000 for the 3 years or $7,500. Her employee has contributed $4,500, of which she's only 60% vested. So the total is the $10,200. These questions are tough. Okay. Virginia Commonwealth University, you get to pick our next question. Protection for 100. Okay, risk management for 100 points. ADHD, a financial planner, had an occurrence basis professional liability policy for many years, and then last year switched to a claims-made policy. A liability claim arose recently from a service that AD provided several years ago. Which policy will cover the claim? 1, claims-made basis policy only. 2, occurrence basis policy only. 3, both the claims-made and occurrence-based policies. And 4 is neither claims-made nor occurrence basis policy. Please start the clock. Ten seconds. And time is up. Students, please submit your answers. Okay, VCU. You selected number 1, and I'm sorry, that's incorrect. Virginia Tech, 1 is incorrect. William Patterson, 2, also incorrect. 3 is correct. Congratulations, Kansas State. Texas Tech, 2, I'm sorry, that's wrong. And University Incarnate Word, 3, that is correct. University of Georgia, 1 is incorrect. And Utah Valley, 1 is incorrect. Our audience, wow. I'm sorry, audience, you're incorrect. Explanation here, since the claim arose during the term of the claims-made policy, coverage is provided by that policy. Since the claim arose from events that occurred during the term of the occurrence basis policy, coverage is also provided by that policy. Okay. Virginia Tech, it is your turn to select a question.
We're going to go investment for 500.
All right. Investment planning for 500 points. Your client, Anita Beer, has the following bond portfolio. Company ABC Corp., fair market value of $23,495, years to maturity 4, yield to maturity 5.2%, coupon 4.75%, duration 3.69. XYZ Corporation, $18,762, years to maturity 5, yield to maturity 6.3%, coupon 5%, duration 4.47. KLM Corporation, fair market value $21,467, years to maturity 2, yield to maturity 3.1, coupon 4.25, duration 1.94. So Anita is going to add 10 U.S. Treasury strips priced $840.73, yielding 3.5% with a 5-year maturity. What is the weighted duration of the new bond portfolio? Please start the clock.
I'm gonna have to make it smaller if we want to see the clock too. About 10 seconds.
10 seconds. Time. Please submit your answers. Virginia Tech, how did you answer? You answered number 3, and that is correct. William Patterson? Also 3, congratulations. Kansas State, 2, I'm sorry, that's incorrect. Texas Tech, 3, you are correct. Incarnate Word, 4, that's incorrect. University of Georgia, 4 as well, I'm sorry, that's incorrect. Utah Valley, 3, congratulations, you're right. VCU, number 1, I'm sorry, that's incorrect. So, how did our audience do? Our audience did well. Congratulations, audience. 3 is the answer because the duration of each individual bond that was given, you only factor in the strip duration for the overall weighted duration. The maturity and duration are the same for zero coupon bonds. No calculation is needed for their duration. Okay. William Patterson University, it is your turn to select where we go.
Let's go with state 300.
All right. State for 300. Okay. Good, we can see this one. So Gabe Wright and Charles Honor have been your clients for over a year. Shortly after the Supreme Court found DOMA unconstitutional, they came to seek your advice on possibly getting married. The state in which they reside recognizes same-sex marriages. Gabe's parents are very supportive of their son and encourage his marriage to Charles. They treat Charles as they do the spouses of their other children. Gabe's siblings are not quite I'm sorry, did I read that right? Yeah, Gabe's siblings are not quite as supportive and are wary of Charles and his motives. Gabe's father has been very successful in his career. At this point, it is estimated that each child will inherit close to $15 million at his death. Which of the following would be benefits of Gabe and Charles' marriage? 1, it eliminates the possibility of a will challenge by Gabe's siblings. 2, it provides for assets to move directly to the survivor. 3, it may lower their overall death taxes at the first to die. Or 4, it eliminates ancillary probate. Please start the clock.
There's a typo.
I know, there are massive typos. The answer to number 1 should say Gabe, right? Yes. Gabe's siblings. Time is up on this one. Please submit your answers, students. Okay, so William Patterson, you selected. How about you tell us how you answered, William Patterson? You said number 2, and I'm sorry, that, so you answered number 2, is that correct? Okay. Number 2 is not the right answer for this one. Kansas State, number 2, I'm sorry, that's not right. Texas Tech, 2 is not correct. Incarnate Word, I'm sorry, that's not correct. Georgia, I'm sorry, that's incorrect. Utah Valley, 2 as well. That's incorrect. And VCU, you said number 4, that's incorrect. Virginia Tech, 2. Incorrect. The correct answer is 3. Their marriage may minimize a successful challenge, but it will not eliminate it. Assets can be titled to move directly to the survivor whether they are married or not. Marriage does not eliminate an estate from probate in any other state. Okay, so let's do a quick score check here to see how we are doing. Kansas State, you have 600 points. Texas Tech, 600 as well. University of Incarnate Word with 200. University of Georgia, 700 points. Utah Valley, also 700 points. VCU, 200 points. Virginia Tech, 800 points. And William Patterson, congratulations, you have 1,000 points. All right, we're back to Kansas State. Where would you like to go, Kansas State? Principals for 300. Ernie and Ivana Flaunted saw an increase in their net worth from $320,000 to $380,000 for the year. During the year, they paid $18,000 in mortgage, principal, and interest. Jim invested $3,500 in a mutual fund by automatic payroll deduction. Diane contributed $3,000.
Ernie and Ivana.
I'm going to read it from your screen. Okay. Okay. I'm going to reread this. I'm so sorry. My notes have some typos in them, and so I'm going to just read it over Mary's shoulder, and it will be exactly what you see on the screen. So I'm going to start this one from the top just to avoid any confusion. So Ernie and Ivana Flaunted saw an increase in their net worth from $320,000 to $380,000 for the year. During the year, they paid $18,000 in mortgage, principal, and interest. Ernie invested $3,500 in a mutual fund by automatic payroll deduction. Ivana contributed $3,000 to an IRA from her savings account. She made deposits from her salary of $2,500 to a money market account. Their investment assets grew by $49,000. What amount of principal reduction occurred in the Flaunted's home mortgage? Option number 1, $2,000. Option number 2, $5,000. Option number 3, $7,000. Option number 4, $11,000. Please start the clock.
It's just, real time. You got it, we're all good.
10 seconds. And time. Time is up. Please submit your answers. Kansas State, how did you answer? You answered number 4. I'm sorry, that is incorrect. Texas Tech, how did you answer? 1. I'm sorry, that is incorrect. Incarnate Word answered number 3. I'm sorry, that's incorrect. Georgia, 4 is incorrect. Utah Valley, 1 is incorrect. VCU, 2 is correct. And Virginia Tech, 1 is incorrect. William Patterson, 2 is correct. Okay, so this one is tricky. The total amount of increase in their net worth, it was $60,000 for the year. They had investment growth of 49,000, savings of 3,500 and 2,500 for a total increase in assets of $55,000. The net worth increase due to the increase in assets through savings and a reduction, it's due to the increase in savings and a reduction of their mortgage liability. The trick here is that, so that's the $60,000 minus the 55. I think the trick here is that the IRA contribution, it did not increase assets because the contribution was from savings. Okay. Texas Tech, where should we go next? Principals for 400. All right. Your firm has recently hired a new employee, Vindictivus, who is to be your assistant. Vin is a candidate for the CFP certification and has passed the exam, but he needs to acquire 3 more months of experience before being fully certified. Today, as you were both handing business cards to prospective clients who were leaving your office, you noticed that Vin had made up his own cards and that he had placed CFP after his name. When confronted with the improper usage of the marks, he replied, "It's just a couple of months, so it's no big deal." Your options are to, 1, inform the principals of the incident and demand that Vin, I think there's a typo, it should be VD, be fired and report him to the CFP board. 2, inform the principals and report the incident to the CFP board. 3, report the incident to the CFP board on the condition of anonymity. 4, tell Vince you will say nothing provided he stops using the cards immediately. Let's start the clock. Ten seconds. And time is up. Okay. Texas Tech, what's your answer? Number 2 is correct. Incarnate Word, 2, you are correct. Georgia, 2. Utah Valley, 2. VCU, 3. I'm sorry, that's incorrect. Virginia Tech, 2, you are correct. Wayne Patterson, 2, you are correct. Kansas State, 2, correct.
It just reversed Texas Tech. Texas Tech had it right.
I'm sorry.
They got it right also.
I'm sorry. All good?
Okay. University of Incarnate Word, it is your turn to pick. Estate planning for 100 points. Okay. Recently, Paul Barrister, an attorney with whom you frequently work, called to inform you that a mutual client, Anthony Tony Richter, had died of pancreatic cancer, and he was recommending you to the executor, William Richter, Tony's brother. 2 weeks later, Mr. Richter, acting as executor of the estate, called to employ you to help facilitate the closing of the estate. The parties of interest in this engagement would be you as the financial planner, and which of the following? A, the estate of Anthony Richter. B, William Richter as trustee of the estate. C, William Richter as personal representative of the estate. Or 4, sorry about that, Barrister J.D., Paul Barrister J.D. Please start the clock. 10 seconds. And time is up. Thank you. University of Incarnate Word, you answered 1, and I'm sorry, that is not correct. University of Georgia selected 2. I'm sorry, that is not correct. Utah Valley, 1. That is not correct. VCU, 1. Not correct. And Virginia Tech, 3 is correct. William Patterson, 2 is not correct. 1, Kansas State is not correct. Texas Tech, 1 is not correct. So the answer is number 3, because the relationship was not established in any of the estate documents. Therefore, the estate is not your client as the planner. A trustee is a fiduciary for a trust, not an estate. Your client, William Richter, acting as executor or personal representative of the state. Paul Barrister was simply the referring attorney in this case. Okay. It is time for our friends from University of Georgia to select the next question. Okay, financial principles for 500 points. Okay, so financial principles for 500 points. Jonathan Greed has just been told that he has inherited some money from the estate of his late grandmother. Under the terms of the will, Jonathan has to choose one of 3 options. Option A, $50,000 today and $60,000 5 years from today. Option B is $50,000 today and $70,000 10 years from today. Option C is $50,000 today and $80,000 15 years from today. If Jonathan's opportunity cost of money is 6%, which of the following statements is correct advice for Jonathan? Answer number 1, option A is the best choice. Answer number 2, option C is the best choice. Answer number 3, option B is the best choice. Answer number 4, option A is the worst choice. Please start the timer. Ten seconds. And time is up. Please submit your answers. Okay, University of Georgia, you answered number 1 and you are right. Utah Valley answered number 2. I'm sorry, that is incorrect. Virginia Commonwealth. Number 1 is right. Virginia Tech, 1 is correct. Thank you. William Patterson, 1 is correct. Kansas State, 1 is correct. Texas Tech, 1 is correct. Incarnate Word, 1 is correct. Thank you so much. So the trick on this one is just doing the present value calculations. Okay. Let's do a quick score check here. Kansas State, you have 1,500 points. Texas Tech, 1,500 points. University of Incarnate Word, you're at 1,100. University of Georgia, 1,600. Utah Valley, 1,100. Virginia Commonwealth at 1,000. Virginia Tech University, you're at 1,800. And William Patterson, 2,200 points. Great job.
So we're about at halfway.
Okay. Okay, folks, we are maybe a little shy of the halfway point, and we've been at it for a good 55 minutes. Why don't we take a 5-minute break? We need to be back in the room. I just want to make sure my watch is synchronized to yours. Please be back at 2 o'clock sharp. So take a quick break, and we will see you in just a few minutes.
Run to the restroom.
Okay, Mary. Thank you, Matt. Okay, everybody, please, let's get settled back down. If everyone can start to find your seat. Okay, please, everybody, let's get settled. We will start the second part of the How Do You Know challenge. I want to send a little reminder out to the audience. Remember, you get to play along. Now, I know you may not have your calculators, but at least a portion of these questions don't require any math. So there's two ways that folks in the audience can participate. You can text the number that Benjamin's showing up on the screen, or you can go to the FPA Experience website. What you need to type into your browser is POLLEV.com/FPA Experience, and you will actually see the question and the answer options pop up. You press on the right one, and that counts in the application. Your answer gets counted for the audience participation part of this. Okay, I want to call out something to folks in the audience. There was a request from the sponsors to flip sides of the room to make sure that we have parity in terms of being able to read the screen. So folks who were on this side of the room are now on that side of the room. So I just wanted to point that out. What I have forgotten is who gets to pick the next question.
Utah Valley. Utah Valley will come this way.
Okay. All right, so we're going to change the order here. Okay, is everybody ready? Shall we get started again? Utah Valley, I think it is your turn to pick where we go next. Retirement planning for 500 points. Okay. Retirement planning for 500 points. This is the question. Manny Bucks is a vital 84 years old and still works as a self-employed handyman. At age 80, he opened and contributed $6,000 to a Roth IRA. In the following 2 years, he converted $10,000 and $20,000 respectively from his traditional IRA. 2 months ago, he met 24-year-old Lovey DeMoney while fixing her toaster. They are planning a 2-week get to know each other vacation. Manny intends to fund the vacation with his Roth IRA, which is currently valued at $50,000. If Manny withdraws the entire amount tomorrow, what are the tax ramifications? Option number 1, the entire amount is withdrawn tax-free. Option number 2, $30,000 will be subject to a 10% penalty. Option number 3, $14,000 will be subject to ordinary income tax. Option number 4, $30,000 will be subject to a 10% penalty and $14,000 subject to ordinary income tax. Please start the clock. Ten seconds. Time's up. Okay, Utah Valley, how'd you answer? Number 3 is correct. Virginia Commonwealth. Number 3 is correct. Virginia Tech. I'm sorry, number 1 is incorrect. William Patterson. Number 2 is incorrect. Kansas State. 4 is incorrect. Texas Tech. 3 is correct. University of Incarnate Word, I'm sorry, 4 is not correct. And University of Georgia, 1 also not correct. Do we want to hear the explanation for this one? Roth distributions come out contribution first. conversions second, and appreciation last. Contributions are never subject to penalties or ordinary income tax. Conversions are never subject to ordinary income tax, but may be subject to a 10% penalty. It's the lesser of 5 years or age 59 and a half. Manny is over 59 and a half, so the $30,000 of conversions are not taxed or penalized. Appreciation may be subject to both. Since Manny is over 59 and a half, the $14,000 is not subject to a penalty, but since it has not been in 5 years from the original contribution, the $14,000 of appreciation is subject to ordinary income tax. That's a tough one. Okay. So we come back to BCU just yet? Okay. All right. We're going to, obviously, we're now going, well, counterclockwise for me, clockwise for you. So, Virginia Commonwealth, it is your turn to pick what our next question is.
Estate for 500, please.
All right. Estate planning for 500. Okay. Estate planning for 500 points. Ben E. Factor is considering a charitable lead annuity trust, that's a CLAT, as part of his estate and philanthropic planning. Which of the following statements about a CLAT is correct? When the trust terminates, the trust beneficiaries must pay gift tax on the trust proceeds that are distributed to them. Option number 2, the maximum term for the lead interest is 20 years. Option number 3, in order to receive an income tax deduction, the grantor of the CLAT must be treated as the owner of the trust for income tax purposes. Option number 4, in general, a CLAT generates a larger tax deduction than a CLUT, of which the death value of the income stream from the trust is included in the grantor's estate. Please start the clock. Ten seconds. And time is up. Students, please submit your answers to your student proctors. Okay, Virginia Commonwealth, how did you answer this one? You answered 2, and I'm so sorry, that is incorrect. Virginia Tech. 3 is correct. Congratulations. William Patterson. 3 is the right answer. Thank you. Kansas State. 4, I'm sorry, Kansas State, that's incorrect. Texas Tech, 4, also incorrect. University of the Incarnate Word, I'm sorry, that is incorrect. And University of Georgia also answered 4, I'm sorry, that is incorrect. Utah Valley, congratulations, you're correct. So the trick with this one is that the grantor of the CLAT must also be treated as the owner. When the trust for option number 1, answer number 1, the trust terminates, the beneficiary may potentially pay income tax on the trust proceeds. Any potential gift tax that would be paid by the grantor when the trust is established. The maximum term for a charitable remainder trust is 20 years. There's no limit on the length of term of years for the CLAT. Finally, option 4, generally the CLAT offers less of a tax deduction as the lead income never increases. Okay, Virginia Commonwealth, you went last, and so it's time for Virginia Tech to pick where we go. Income tax planning for $500. Okay. Patsy Vitae has passive activity as presented below. $50,000 in salary, $10,000 passive loss from bad limited partnership, $2,000 passive income from Okie Dokie Limited Partnership, $5,000 loss on the sale of the Bad Limited Partnership, $6,000 of suspended losses from Bad Limited Partnership. In the year of disposition of Bad, what is the amount she can take against ordinary income? Answer number 1, $2,000. Answer number 2, $8,000. Answer number 3, $16,000. Answer number 4, $21,000. Can we please start the clock?
See the clock and all the answers. About it. 10 seconds.
10 seconds. And we're at time. Okay. Virginia Tech, I believe you selected this one. How did you answer? You answered number 1, and I'm sorry, Virginia Tech, that is not the right answer. William Patterson. You also selected 1. I'm sorry, that is incorrect. Kansas State. You selected 3, and you are correct. That is the right answer. Texas Tech. 2, I'm sorry, Texas Tech, that's not right. University of Incarnate Word, you also selected 2, not right. University of Georgia, 3, congratulations. You answered correctly. Utah Valley answered 2, I'm sorry, that is not the right answer. And VCU, you answered 3, okay. And VCU answered 3, and that is correct. Okay, so the trick with this one is Brenda can deduct $16,000 of her passive losses. The first $2,000 offsets her passive income. The remaining losses can be taken against active income. The $5,000 loss on the sale of Bad, it's a capital loss. Okay. Virginia Tech, it is time for William Patterson to select where we go next. Good deal. We will select estate planning for $400. Okay. Estate planning for $400. Dan's parents established the Skipling Family Trust for Dan at their death and Dan's children at his own passing. On the 5th anniversary of Dan's death, the trust will distribute 25% of trust assets to the children, 50% of the remaining trust assets on the 10th anniversary, and the remaining assets on the 15th anniversary of Dan's death. The trust provides that Dan receives a $10,000 distribution every year until his death. The question is, what type of GST event occurs when the Skipling Family Trust makes the first distribution to Dan's children? Option number 1, direct skip. Option number 2, taxable distribution. Option number 3, taxable termination. Option number 4, none. The distribution is not subject to GST tax. Please start the clock. Ten seconds, students. And time is up. Okay, William Patterson, how'd you answer this one? You selected 2, and I'm so sorry, that is not right. Kansas State, 4 is the correct answer. Texas Tech, 3, I'm sorry, that is not the right answer. University of Incarnate Word, you selected 4, congratulations, that's right. Georgia, 2. I'm so sorry, that's incorrect. Utah Valley, you selected 2, also incorrect. VCU, you selected number 1. I'm sorry, that's not right. And Virginia Tech, you answered 2. I'm sorry, that is incorrect. So this, again, this is a tough one. At Dan's death, there was a taxable termination, and Dan's interest is then terminated. The trust continued for the benefit of Dan's children, who are the grandchildren of the grantor of the trust. That's Dan's parents. Since the remaining beneficiaries were all skip persons, GST tax was due when Dan died. A is incorrect, as the direct skip occurs only when the initial transfer is just to skip persons. B is incorrect, as the taxable distribution occurs when a trust for the benefit of the skip and non-skip persons makes a distribution to a skip person. Audience, I am really sorry. You are not doing well on that one either, so thanks for playing along. Okay, it is time for Kansas State to select which question we answer next.
We'll take retirement for 400.
Okay, retirement planning for $400. Lynn Kraft and her sister Pearl own a boutique eye care store. They offer full services and have on staff 2 ophthalmologists, a plastic surgeon, 3 optometrists, and 2 aides. Their salaries are listed below. Lynn Kraft, $75,000. Pearl Spector, $75,000. Plastic surgeon, $325,000. Ophthalmologist 1, $250,000. Ophthalmologist 2, $225,000. Optometrist 1, $150,000. Optometrist 2, $125,000. Optometrist 3, $125,000. The first aide number 1, makes $40,000 a year. Aide number 2 makes $35,000 a year. Who are the highly compensated employees? Answer number 1, Lynn and Pearl. Answer number 2, the plastic surgeon and the ophthalmologist number 1. Answer number 3, Lynn, Pearl, the plastic surgeon, and ophthalmologist 1. Answer number 4, the plastic surgeon, ophthalmologist 1, ophthalmologist 2, optometrist 1, optometrist 2, and optometrist 3. Mary, please start the clock. You have 10 seconds. And we're at time. Okay. Kansas State, how did you answer? You answered number 3, and that's correct. Congratulations. Texas Tech, how did you answer? You answered 3. Congratulations. You are correct. University of Incarnate Word, 3. Good job. University of Georgia, I'm sorry, 1 is not the right answer. Utah Valley, 2. I'm sorry, that is not correct. VCU, you answered 2. I'm sorry, that's incorrect. And Virginia Tech, 4. I'm sorry, that is not the right answer. William Patterson, 3. Congratulations, that is the right answer. Covered everybody, right? Okay. So the explanation on this one, as greater than 50% owners, Lynn and Pearl are highly compensated regardless of their actual earnings. The plastic surgeon and first ophthalmologist are also highly compensated, even though there are 4 other employees making an excess of $115,000 a year. They are not among the top 20% of wage earners. Okay, let's do a quick check on how we are doing with scores. Kansas State, you have 2,800 points. Texas Tech, you're at 2,400 points. University of Incarnate Word, 1,900 points. University of Georgia, 2,100 points. Utah Valley, 2,100 points. VCU, 2,000 points. Virginia Tech University, 2,300 points. And William Patterson, congratulations, you're in the lead with 3,100 points. Yes, Virginia Tech. Okay, we have a challenge. So as we discussed, the rules are that you need to provide your rationale.
Well, I thought you said the 20% rule for the top 20%, because the people, even though they're making over 115,000, you said because they didn't, even though they made over the 115,000, they weren't the top 20%, but I thought that rule was like an optional rule. So everyone that was above 115,000 was highly compensated.
Okay, we have to submit your challenge to the judges. They will confer among themselves. I'm going to reread the explanation just in case I misread it or if there are any questions about what the official explanation is. So the explanation is that regardless of their earnings, Lynn and Pearl are greater than 50% owners, so they're automatically included. The plastic surgeon and first ophthalmologist are also highly compensated. Even though there are 4 other employees making in excess of $115,000, they are not among the top 20% wage earners.
Well, because even though it didn't include the owners, you should have included everyone that was listed on option 4 was making over the so the other answer would still be correct.
I'm sorry, Virginia Tech, can we just make sure you're talking into the
Oh,
microphone so
sorry.
everyone can hear? Thank you.
Yeah, okay. Well, I was just
Okay.
saying because the limit to be highly compensated is 100 or over 115,000. Everyone in answer 4 was making over the 115,000. So I think option 2, or was it option 2?
So the correct
Also
answer was
correct.
option 3.
Oh, option 3. That's what I meant. But I think option 3 is correct along with option 4 because everyone from option 4 was technically highly compensated over the 115,000 limit.
Okay.
But there wouldn't have been a correct answer, because the
Yeah.
owners weren't included, so that wouldn't have been a correct answer anyways.
Our judges their brain power is working very quickly right now, and so they are the ones who adjudicate the challenge. The judges do not have a timer, I'm sorry. It's a privilege of being a judge.
I'm
It's a good
sorry.
question,
I'm
though.
sorry.
So I just want to make sure that we understand the issue. Your concern is that both option 3 and option 4 could be correct, and therefore it is not fair to say that option 3 is the only
Because
correct
both
answer.
every employee was highly
Yes.
compensated.
Option 4 still does not have the owners listed in it at all, so it can't possibly be correct.
So they would both be wrong then.
Correct answer.
Okay.
Because it didn't include all.
Financial planning is art and science, as you can see.
Plastic surgeon. I'm sorry.
Okay. So we had a request to repost the question in we actually have a technology limitation. We can't go and repost it. So our judges, it sounds like, have come up with a determination.
Is this on? Yeah. We've decided to, if possible, throw out the question, just have no right answers or wrong answers. So,
The reason, hi. there was a correct answer to the question. I don't remember what the option for number 4 was, but are the owners listed? The owners are not listed, so although their challenge is correct, they forgot to list the owners among option 4. The correct answer, as stated, is the only correct answer that there is.
But you did say three, forgot to list the rest of the people.
Did the question say all or some?
No.
Okay,
No.
so I'm,
It's absolutely correct.
okay, so just for everyone in the audience's sake, I'm going to reread the question. The question was, who are the highly compensated employees? So, thank goodness for Benjamin and the
We did feel
audience
that
participation.
question number 3 and choice number 3 and choice number 4 are correct, but not fully correct. 4 doesn't have the owners; those people are highly compensated, but it cannot be the correct choice because it doesn't include the owners. 3,
Are under any count.
right?
Okay. So, Rita, I just want to make sure. So, the judges are saying 3 is the only correct answer, or are they saying something different than that?
They're incomplete. It is correct given the choices, but we felt that it could be a little misleading, so we want to throw out the questions so that no one gets credit.
Okay. How would we do that on the scoring?
So we either have to give it to everybody or we give it to nobody. That way everyone is equal.
We could give it to everyone.
So this is like a bad test question.
Or
So
to
if
nobody.
you were taking the CFP exam, the CFP certification exam, this would be one of those questions that would take it out where no one would be penalized for getting it wrong, or we give everyone free points
Okay.
so that you're not disadvantaged.
I've just undone everybody's answer, and let's just move on.
Okay. That is how we're going to handle this. This question didn't count. It's as if it didn't happen.
No, I undid the.
Okay.
I undid the.
So no one will have any points added for this question. So no. So it's 0 points for everybody for this question. Did I get it right?
Yeah.
Okay.
Don't look at the radio button that's clicked. I clicked undo. It subtracted any points that were added as a result of that, but it did not unclick the radio button.
Okay. Let's refresh where we are with total scores. So that question, it was a complete do-over. No points were added to anyone's scores. So Kansas State, you have 2,400 points. Texas Tech, you have 2,000 points. University of Incarnate Word, 1,500 points. University of Georgia, you're at 2,100 points. Utah Valley, 2,100 points. Virginia Commonwealth University, 2,000 points. Virginia Tech University, 2,300 points. William Patterson, 2,700 points. Okay, let's move on. Texas Tech, I believe it is your turn to select where we go next. I'm sorry, I did not hear what you said. Okay, we have a request for protection for 500. Okay. Protection for 500. Hazel and Jep Artie have their home insured under an HO3 policy. The original amount of the coverage on the dwelling was $100,000 and has been left unchanged for several years. Yesterday, the home was struck by lightning, causing $10,000 of damage as measured by actual cash value and $18,000 of damage as measured by replacement cost. The market value of the home at the time of the lightning damage is estimated at $200,000, of which $50,000 is attributed to the land value. Disregarding any deductibles, which of the following amounts will Jack and Robin recover from the insurer? Option number 1, $18,000. Option number 2, $10,000. Option number 3, $11,250. Option number 4, $15,000. Please start the timer. You have 10 seconds. And time is up. Okay, students, please submit your answers to your student helpers. Texas Tech, how did you answer this one? You answered number 3, and I'm sorry, 3 is not correct. University of the Incarnate Word, you answered 2. I'm sorry, that is not right. University of Georgia, 1, also not right. Utah Valley, 2. I'm sorry, that's the wrong answer. Virginia Commonwealth, you answered number 4, and 4 is the correct answer. Congratulations. Virginia Tech, you answered number 1. I'm sorry, that is not correct. William Patterson, you answered 4. Congratulations, that is correct. Kansas State University, you answered number 3. That is not correct. Okay, so audience, I'm so sorry, audience. That was a tough one. Okay, so let me, because of that, let me read the explanation here. If the amount of insurance carried is less than 80% of the dwelling's replacement cost at the time of loss, the insurer will pay the greater of the actual cash value of the loss or the amount produced by a formula. It's amount carried divided by required amount times replacement cost. Here, those numbers yield the $15,000 that are represented in answer number 4. Since this exceeds the $10,000 of ACV of the loss, the $15,000 will be paid. The full fair market value is not used as the land does not have to be replaced in this particular case. Okay, or any case for that matter. It is time for University of Incarnate Word to tell us where we're going to go next. Okay, income tax for 400. Okay, so Billy Bogus was being sued for divorce by his wife and high school sweetheart, Desperata. Billy wanted to get the biggest tax deduction possible, and his attorney came up with this schedule. Year 1, $50,000. Year 2, $20,000. Year 3, $20,000. What was the total alimony recapture, if any, for Billy? Let's start the clock. Oh, I'm sorry, the answers. My apologies. So answer number 1 is 0. Answer number 2, $7,500. Answer number 3, $10,000. Answer number 4, $15,000. Now let's start the clock. Ten seconds. Time's up. Okay. University of Incarnate Word, how did you answer? You selected answer number 3, and I'm sorry, that is not the right answer.
It says it's
Oh.
the right answer here.
Oh, wow. Okay, that's a twist. Congratulations, University of Incarnate Word, you did select the right answer. You selected number 3. It is 4. Okay. Yep. It's right. We just have a programming error. The right answer is number. I was thinking through my head, I was like, we worked through this one this morning, and so I know the rationale for this one, and so we will talk about the rationale. The right answer is number 4. I'm sorry, University of Incarnate Word. The answer is number 4. $15,000 is the amount of alimony recapture in this particular case. University of Georgia, you answered correctly. Thank you. You answered number 4. Utah Valley, I'm sorry, you did not answer correctly. 1 is not the right answer. VCU, you answered 3. I'm sorry, that's incorrect. Virginia Tech, 2 is not the right answer. William Patterson, 1. I'm sorry, that is not correct. Kansas State, I'm sorry, is 3 the answer you're selecting? I'm sorry, that is not correct. And finally, Texas Tech, you answered 3 as well. Okay, so the rationale for this is that the alimony received in year 2 can't exceed the alimony received in year 3 by more than $15,000. The alimony received in year 1 can't exceed the average of year 2 and 3 plus $15,000. So in this case, the average of year 2 and 3 is $20,000 plus an additional $15,000, makes the amount of recapture the $35,000. As you can see, the gentleman paid $50,000. The difference is the $15,000 that's represented in option number 4. Okay, let's do a quick check on where we are with points. We have, how many questions do we have left? 9? No.
No. 11?
Okay. So we have 11 questions left, and here's where we are with scores. Kansas State, 2,400 points. Texas Tech, you have 2,000 points. University of Incarnate Word, you're at 1,900 points. UGA, 2,500 points. Utah Valley University, 2,100 points. Virginia Commonwealth University, 2,500 points. Virginia Tech, 2,300, and William Patterson, 3,200 points. Congratulations, William Patterson. Okay, University of Georgia, I believe it's your turn to pick where we go next.
We're going to go with
Investments for 400. Okay. All right. Investments for 400. Looking at himself in the mirror one morning, Harry Navel begins to contemplate changes to his investment portfolio. He has found a security with a negative 0.7 correlation with his existing portfolio. Which of the following measures would be most relevant to gauge the risk-adjusted performance of this hypothetical portfolio? Option number 1, security market line. Option number 2, Jensen. Option number 3, capital market line. Option number 4, trainer. Let's start the clock. Ten seconds. And students, we're at time. Okay, University of Georgia, how'd you answer this one? You selected number 2, and I'm sorry, that is not the right answer. Utah Valley, option number 4, I'm sorry, that is not the right answer. VCU, option 4, I'm sorry, that's incorrect. Virginia Tech, option number 3 is correct. Congratulations. William Patterson. I'm sorry, 2 is incorrect, William Patterson. Kansas State, I'm sorry, 4 is not the right answer. Texas Tech, 4, I'm sorry, that's incorrect. And University of Incarnate Word, I'm sorry, 4 is not correct. So the explanation here, the capital market line uses standard deviations as its risk-return measure. This is not to be confused with the capital asset pricing model, CAPM, which is the same as the security market line. The asset is negative 0.7 correlated, resulting in a coefficient of determination of 0.49. Since only 49% of the portfolio movement will be attributed to market risk, beta is not a valid measure. The capital market line is the only model that uses standard deviation. Okay, Utah Valley, you get to pick where we're going to go. You said retirement? Okay, let's go to retirement planning for 300 points. All right, retirement planning for 300 points. Donnie Needed is 63 years old. He's self-employed and semi-retired. He took an early retirement package to get out of the lucrative but high-stress position as an advertising executive at a major New York firm. He is well secured as to his monetary needs for retirement, but works part-time for a nonprofit association supporting a cause that he has always championed. He is employed as an independent contractor filing under Schedule C. He does not need any of the income for current living expenses, and due to a generous severance package, is still in the 35% tax bracket. He plans to fully retire at age 66 and wants an easy-to-administer retirement plan that maximizes his tax deduction. His net income that he can contribute against is $30,000. The best recommendation would be answer number 1, defined benefit plan, 2, a simple 401k, 3, a 457 tax advantage plan utilizing the special catch-up provision provided for the last 3 years before retirement. Option number 4, solo 401k with profit sharing. Let's start the clock. Ten seconds. And time. Okay. Utah Valley, how did you answer? You answered number 4, congratulations, that's right. Virginia Commonwealth, how did you answer? Virginia Commonwealth, I'm sorry, answer number 3 is not correct. Virginia Tech. Number 1, I'm sorry, Virginia Tech, that's incorrect. William Patterson. Number 3, I'm sorry, that is not the right answer. Kansas State, how did you answer? 3, I'm sorry, Kansas State, that's incorrect. Texas Tech. 3, again, I'm sorry, 3 is not right. University of Incarnate Word, I'm sorry, 3 is not the right answer. Georgia, I'm sorry, that's incorrect. Number 2 is not right. Okay, congratulations, Utah Valley. Answer 4 was the correct answer. So the trick with this one is Donnie's over age 50, so he would be able to defer $17,500 plus the $5,500 catch-up for a total of $2,300. He then could make a profit-sharing contribution of $6,000 for a total of $29,000 deferred. 1 is incorrect because it's not easy to administer and would be subject to a reduction of benefit by 70% for a maximum benefit of $9,000 a year. The simple 401k limits the deferral amount, and a 457, it's for a nonprofit or government employee, and Donnie is self-employed as a contractor. Okay. VCU, it is your turn to pick where we go next. All right. Thank you, VCU. Okay. Protection planning for 400. The non-contributory group universal life insurance plan covering Ben E. Fitz, age 43, provides a formula amount equal to 3 times annual income. If Ben's annual income is $105,000, what is the annual amount of his imputed income from the group insurance? Please note, Table 1 cost of insurance at age 43 is 15 cents per thousand per month. Answer number 1, there is no imputed income. Answer number 2, $567. Answer number 3, $477. Answer number 4, $39.75. Let's start the clock. Mhm. We're at 10 seconds. And time is up. Okay, VCU, how did you answer this one? Okay, you answered number 3, and I'm sorry, number 3 is not the correct answer. Virginia Tech? I'm sorry, Virginia Tech, that is not the right answer. Number 3 was not right. William Patterson? You also selected number 3. Okay, I'm sorry, William Patterson, that's not correct. Kansas State, you answered 3. I'm sorry, that's incorrect. Texas Tech? 3. I'm sorry, Texas Tech. University of Incarnate Word, I'm sorry, 3 is not right. University of Georgia, I'm sorry, 4 is not the right answer. Utah Valley, I'm sorry, 3 is not the right answer. Okay, so the correct answer here is 2, $567. The entire amount is taxable as this group for this group universal life policy. The calculation is 3 times 105,000 equals 315 times the 0.15 times 12 months. Sorry, friends. Okay. Let's do a quick tally of the points here and just see where we are. We've got Kansas State with 2,400, Texas Tech with 2,000, University of Incarnate Word with 1,900, University of Georgia 2,500, Utah Valley University 2,400 points, Virginia Commonwealth University 2,500 points, Virginia Tech University 2,700 points. William Patterson, congratulations, you're still in the lead, 3,200 points.
I have a question.
Yes, sir.
On the last question, you said it was non-contributory, so is the assumption that the employer is making all the contributions?
I do not remember which one that was.
Protection planning for 4.
Protection planning. Let me just reread the question and we will check on that. Oh, okay. That's correct. So, I'm sorry, what is your question again? Okay, thank you.
Universe is not turf. Turf is the only one that qualifies for 50,000 in its whole lifetime effect policy. It's not qualified for entire amount.
Okay, thank you. Challenge from the audience. Thank you so much for clarifying that. Okay, it is time for Virginia Tech to select our next question. We only have, what, 8 left? Did I get that right? Tax for 300. Income tax planning for 300 points. All right. Generali received 5,000 ISOs with an exercise price of $12. She sold the share options 4 years later for $25 per share. The options had been exercised 15 months prior to the date of sale at $20 per share. What were the AMT ramifications to Jen when the options were granted? Answer number 1, there was no AMT, but an adjustment of $65,000 of ordinary income was made. Option number 2, 0. Option number 3, $25,000. Option number 4, $65,000. Let's go ahead and start the clock.
Yeah, I just like to see change.
10 seconds.
So I keep meaning to check on it, but getting so caught up in making sure I hit the right button, but I don't.
And students, we're at time. Please submit your answers. Okay, Virginia Tech, how did you answer this one? You answered number 3, and I'm sorry, that is not the right answer. William Patterson University. Also number 3. I'm sorry, William Patterson. Kansas State, 3. Kansas State, that's not correct. Texas Tech, you answered 2. Congratulations. That is the correct answer. University of Incarnate Word, congratulations. You answered number 2 as well. University of Georgia, congratulations, Georgia. You answered number 2. Utah Valley, I'm sorry, number 1 is incorrect. And VCU, answer number 4 is also incorrect. So the explanation for this one, at the date of grant, there is no recognition of AMT or ordinary income. The question was about the grant date. Okay, William Patterson, it is your turn to select our next question.
Before we select, can we request a break after this question?
I'm sorry, we've already had a break. Is there a medical emergency that we need to see to?
No, restroom break. We got that long break in between the judges, so we maybe a 2-minute after break. We got a couple people saying please.
Okay, yes. In fact, why don't we just go ahead and take, it will literally be a 3-minute biology break, adjust liquids accordingly, and seriously, be back in the room in 3 minutes. Audience, if you don't have a biology emergency, I would request that you stay in the room because we are actually at our time and we still have, obviously, a handful of questions to go. Okay, are all the schools back? Everyone from all the schools, are we back in our seats? Okay. Let's start the third part of our How Do You Know challenge. Here we go. No worries, no worries. Okay, William Patterson, it is your turn to pick which question we go to. Excellent. We shall go to estate planning for 200 points. In the current year, Sally Generous gave gifts of $41,000 each to her mother, her daughter, her husband, and her college. Sally also created a trust that will pay income to her daughter for life and the remainder to her son. The present value of the income interest is $150,000, and the remainder interest has a present value of $40,000. If Sally and her husband elect to split gifts but make no other special elections, what is the total amount of taxable gifts that Sally must report on a gift tax return? Option number 1, $80,000. Option number 2, $94,000. Option number 3, $108,000. Option number 4, $132,000. Let's go ahead and start the clock. Ten seconds. Okay, students, we are at time. William Patterson, how did you answer this one? You answered number 2, William Patterson. I'm sorry, that is not the right answer. Kansas State. Number 4 also is incorrect. Sorry, Texas Tech. You answered number 2. 2 is incorrect. University of Incarnate Word, I'm sorry, 4 is incorrect. University of Georgia, I'm sorry, 1 is incorrect. Utah Valley, I'm sorry, 3 is also incorrect. I'm sorry, 3 is correct. You've broken me. No. 3 is the correct answer. Thank you. 3 is the correct answer. And Virginia Tech. I'm sorry, VCU, and then Virginia Tech. 3 is correct. Thank you. Virginia Tech, 3 is correct. Okay. So the explanation on this one, Sally's gifts to the husband and college are not taxable gifts because of the marital and charitable deductions. The gift to her mother and daughter will be split, and the annual exclusion will reduce the taxable gift to, my answer says $6,500 each. The total of these 2 taxable gifts is $13,000. The $150,000 gift in trust for the daughter will be split with her husband, so they're each contributing $75,000 each, but that will be offset by an annual exclusion, and also give her daughter, I think the amount going to the daughter is $41,000, right? Yeah. For this year. The remainder interest to the son is a future interest gift, so the annual exclusion does not apply. The gift will be split with Sally's husband, so the gift by Sally is $20,000 because she's splitting the $40,000. So the total taxable gift is $6,500 plus $6,500 plus $75,000 plus the $20,000. That gets you to $108,000. Okay. Kansas State, it is your turn to select where we go next. Okay.
Was it 300 or?
Yes, 300. So protection planning for 300 points. Jan and Cal Ipper have been married for 6 years and have 3 children, ages 2 to 5 years old, one of whom is a special needs child. Cal is one of 15 employee mechanics at an auto repair shop, all covered by the employer's health plan. Jan and Cal have been having marital difficulties and are contemplating divorce. If they go through the divorce, how many months will Jan and the children be covered under COBRA? Option number 1 is 0 months. Option number 2, 18 months. Option number 3, 29 months. Option number 4, 36 months. Let's go ahead and start the clock. 10 seconds. Students, we're at time. Kansas State, how did you answer this one? Kansas State, you answered number 2. I'm sorry, that is incorrect. Texas Tech, 2 is incorrect. University of Incarnate Word, 2 is incorrect. University of Georgia, 2 is incorrect. Utah Valley, 2 is incorrect. VCU answered 4. I'm sorry, VCU, that's incorrect. Virginia Tech is 2. I'm sorry, that's incorrect. William Patterson, you answered correctly. The answer is number 1, 0 months. Okay, so here's the explanation on this one. COBRA covers employers with 20 or more employees. The auto shop only has 15 employees, so COBRA does not apply to this company. Okie dokie. Texas Tech, I believe it is your turn to select our next question. Where shall we go? Okay, thank you, Texas Tech. We're going to do retirement planning for 100 points. Here we go. At which point does an employer get a tax deduction for an ISO? Option number 1, at the time of grant. Option number 2, at the time of exercise if not held for more than 2 years. Option number 3, at the time of sale if not held for more than 2 years. Option number 4, at the time of exercise if not held for more than 2 years from the date of grant. And 1 year from date of exercise to date of sale. Let's start the clock. We're going. Excellent. Ten seconds. And we're at time. Okay, Texas Tech, how'd you answer this one? You answered number 4. I'm sorry, that is incorrect. University of Incarnate Word, you answered 2. I'm sorry, that's incorrect. University of Georgia, you answered 4. I'm sorry, that is not the right answer. Utah Valley, 4, also incorrect. VCU, I'm sorry, 4 is not the right answer. Virginia Tech, how did you answer? You answered number 1. I'm sorry, that's wrong. And William Patterson, 4, incorrect. Kansas State, 1 is incorrect. The correct answer for this is number 3. An employer never gets a deduction until an employee recognizes ordinary income. For ordinary income tax purposes, the treatment of an ISO cannot be determined until the date of sale. Answer number 1 will never be true. Therefore, 2 may ultimately result in the recognition of ordinary income taxes, but never at the time of exercise. Option 4 will result in recognition of ordinary income, but not at the time of exercise. Okay. University of Incarnate Word, I believe it is your turn to pick where we go next. All right. Investment planning for 100 points. Okay, investment planning for 100 points. You and your client, Xavier Pennies, decided he needed to invest in tips to satisfy his long-term goals and risk tolerance. Which of the following accounts is best suited to hold his assets, this asset? Option number 1, Roth 401k. Option number 2, TOD brokerage account. Option number 3, 401k. Option number 4, joint tenants with rights of survivorship brokerage account with his wife. Please, let's start the clock. 10 seconds. And students, we're at time. Please submit your answers to your proctors. Okay, University of Incarnate Word, how did you answer this one? You selected number 2, and I'm sorry, that is not the correct answer. University of Georgia, you answered number 1. I'm sorry, that is incorrect as well. Utah Valley, I'm sorry, incorrect. VCU, you answered 2. That is incorrect. Virginia Tech, 4 is incorrect. William Patterson, 4, also incorrect. Kansas State, 4, I'm sorry, that's incorrect. And Texas Tech, you answered 4, that is incorrect. So the answer here, both the interest and inflation adjusted par are taxable, with the inflation adjustment being phantom income. All of the other accounts are better used for appreciation and/or capital gains and qualified dividends. That is why option number 3, the 401k, is the best option. Okay, University of Georgia, we're in the home stretch. Where would you like to go?
200 for protection.
Okay. Valedictorian has a major medical policy with a $500 deductible, 80/20 coinsurance, and stop-loss limit of $2,000. During the course of the year, Val has incurred the following expenses in this order: $4,000, $3,000, and $2,000. How much will Val have to pay for the final $2,000 medical expense? Option 1 is 0, option 2, 200, option 3 is 400, option 4 is $500. Let's go ahead and start the clock on this one. You have 10 seconds. Students, we're at time. Please submit your answers to your proctors. Okay. UGA, I believe you selected this one. How did you answer? You answered number 3. I'm sorry, 3 is not the right answer for this one. Utah Valley, I'm sorry, 3 is incorrect. VCU, 2, congratulations. 2 is correct. Virginia Tech, 1 is not the correct answer. William Patterson, 3, I'm sorry, is incorrect. Kansas State, 1, also not correct. Texas Tech, you're also 1, that's incorrect. University of Incarnate Word, 3 is incorrect. So the correct answer is 2. For the first incident, Val would pay her deductible of $500 plus 20% coinsurance on the remaining $3,500 or $700. For the second incident, she pays $600, and then for the last incident, she would normally pay $400, but she's hit her stop-loss limit of $2,000, and so she only pays the $200 that are represented in answer number 2. Okay, we have 2 questions left, I believe. Utah Valley, the choice is yours. Okay, so we're going to go for investments for $300. All right. Being an aggressive investor, Steward Shorty Call Put is interested in making some money during a flat market. Shorty sells one ABC January 65 put at $4 when ABC is at 61. The market price goes up to 72 and the option is exercised. What is the intrinsic value of the option? Answer 1, negative $400. Answer 2, negative $300. Answer 3, $0. Answer 4, $400. Let's go ahead and start the clock. Ten seconds. And students, the time is up. Please submit your answers. Okay, Utah Valley, how'd you do? You selected number 4, and congratulations, 4 is the right answer. Well done. VCU, I'm sorry, 1 is incorrect, VCU. Virginia Tech, 4, congratulations, good job. William Patterson, 4, fantastic. Kansas State, I'm sorry, 1 is incorrect. Texas Tech, I'm sorry, 1 is incorrect. University of Incarnate Word, I'm sorry, you're right. Congratulations. University of Georgia, 1, I'm sorry, 1 is not the right answer. The answer is number 4. The question asks for intrinsic value, not gain loss. The intrinsic value is the dollar amount an option is in the money at the time of the initial buy-sell. Puts her in the money when the market price is below the strike price. So the option is in the money by $400. Okay, I believe we have one question left in our regular round, and then I think, as everybody knows, we have a final question. So here we go. This is our last official question here. Your new client, Olive Martina, seems intimidated by the risk tolerance questionnaire you have presented to her and is reluctant to complete it. You should, 1, inform her that it must be completed for you to fulfill your fiduciary responsibilities. 2, you can go no further with the plan unless it is completed and may have to withdraw from the engagement. 3, try to ascertain her risk tolerance through past actions and leading questions. 4 is use open-ended questions to determine her risk tolerance. Start the clock, please. Ten seconds. Okay, folks, we're at time. Since we left off on this side of the room, VCU, how would you like to be our first one to respond? Okay, that is correct. VCU answered correctly. 4 is the answer. Thank you, VCU. Virginia Tech, 4, right. William Patterson, 4, thank you. Kansas State, you answered number 3. I'm sorry, Kansas State, that's incorrect.
VCU was yes, Kansas State was no.
Okay.
That's good enough.
Okay. Texas Tech answered correctly. Number 4, thank you, Texas Tech. University of Incarnate Word, thank you. You answered correctly. That's right, number 4. Georgia, thank you. Number 4 is correct. Thank you, Utah Valley. You are correct. Answer 4 was the right answer. So the rationale here is a risk tolerance is neither the only way nor sometimes even the best way to determine a client's risk tolerance. The information can be attained through open-ended questions and a conversation with the client. Leading questions tend to put words into clients' mouths and may reflect your own risk tolerance more closely than the client's. The questionnaire, and I think this is tricky here, the questionnaire is not crucial for creating a successful and accurate plan. Okay, let's do a quick tally. We are near the end. So, here's where we stand. Kansas State, 2,600 points. Texas Tech, you're at 2,500 points. University of Incarnate Word, 2,700 points. University of Georgia, 3,000 points. Utah Valley, congratulations, 2,100 points. VCU, 3,100 points. Virginia Tech University, 3,400 points. And finally, William Patterson, you're in the lead with 4,000 points. Okay, we are ready for our final question. It's worth 750 points. Everyone take a deep breath, relax, maybe stretch your shoulders a little bit, do a little stretch. Okay, are we ready to get started? This is it, we're very close. Okay, here is the final question. It is not tax planning. We have a little, yes, let's just read the final question. Jaylene and James Doding have just given birth to their first child, Matthew. For his first birthday, they want to start funding his college education. He will start school at age 18. They would like for him to attend their alma mater, which has currently yearly tuition of $35,000, current yearly tuition of $35,000. They expect tuition to rise at 4% and feel they can earn 6.5% after an after-tax return, 6.5% after-tax return. If they make their first deposit on Matt's first birthday and continue in equal payments each year, how much will they have to deposit each year to fund Matt's education? Option number 1, $7,746. Option number 2, $7,932. Option number 3, $8,249. $8,249. Option number 4, $8,447. Let's go ahead and start the clock. Students, you have 15 seconds. Okay. Time is up. There's smoke coming out of calculators. That was a lot of keystrokes. Okay. Let's go ahead and reveal the answer. Option number 4 is the correct answer. Virginia Tech, I think we left off with you. Would you like to go first? You selected number 1. Virginia Tech, I'm sorry, that's incorrect. William Patterson, 4. Congratulations, well done. Kansas State, also 4. Well done, Kansas State. Texas Tech, you selected number 2. I'm sorry, that is incorrect. University of Incarnate Word, I'm sorry, 3 is incorrect. University of Georgia, 3 is incorrect as well. Utah Valley, 3. I'm sorry, Utah Valley, that's incorrect. And VCU, you selected number 2. I'm sorry, it was number 4, so VCU incorrect. Okay. Congratulations, everybody. Please give me, everyone, join me in giving a round of applause to the students. So quickly, my friends from Texas Tech, you're already leaving. Let's figure out who won. So the winner for this round was William Patterson. Congratulations, William Patterson. Virginia Tech, congratulations. You came in second place with 3,400 points. Kansas State, great job, 3,350. Utah Valley came in fourth place with 3,100. Okay, I do want to make a quick announcement for students and faculty sponsors. Please join Ameriprise bright and early tomorrow morning. We're hosting a student reception in the Hyatt Regency, which is the hotel across the street. It starts at 6:30. We promise there will be food and plenty of coffee and caffeine.